Okay, let's go ahead and talk about consolidated earnings per share, and let's go ahead and keep this simple and straightforward. Um, Now, earnings per share, both basic and diluted, is something you should be familiar with from your previous courses, especially Intermediate Accounting 2 or the equivalent. Consolidated earnings per share is similar to earnings per share for an individual company. Now, consolidated earnings per share is prepared from the perspective of the parent company shareholders. It's earnings per share of parent company common stock. Now, basic earnings per share is net income minus preferred dividends divided by weighted average shares outstanding. And just as was the case for an individual company, the preferred dividends, if the preferred stock is cumulative, the preferred dividends are deducted whether declared or not. If the preferred stock is not cumulative, then the preferred dividends are deducted only if the dividends are declared. Now let's go ahead and go through those three terms one by one. First, for net income. The net income is the income to the controlling shareholders. The preferred dividends that we deduct are the preferred dividends for the parent only. If the subsidiary has preferred stock, then the dividends to the subsidiary's preferred stock are already deducted as part of the income to the non-controlling interest. Finally, the weighted average shares outstanding is for the parent's shares only. Again, this is earnings per share of parent company stock. So let's go ahead and run through an example. Let's assume that Big owns 60,000 shares, or 60% of Little's common stock. Big and Little each report $100,000 of income from their own operations. Little was acquired at book value, so there's no differential amortization to worry about. And let's assume that Big and Little each have 100,000 weighted average shares of common stock outstanding during the year. Big pays preferred dividends of 20,000, while Little paid preferred dividends of 10,000. And let's assume that Big owns none of Little Company's preferred stock. First, just for old time's sake, let's go ahead and compute basic earnings per share for each company individually. For Big Company, they've got $100,000 of income, less $20,000 of preferred dividends, over 100,000 shares, or 80 cents per share. Little has income of $100,000, less $10,000 of preferred dividends, over 100,000 shares, or 90 cents per share. The income to the non-controlling interest. Now, there are two groups of non-controlling shareholders. Those who hold Little's preferred stock are non-controlling shareholders. Likewise, the people who own the other 40% of Little's common stock are also non-controlling shareholders. So there are two components to the non-controlling interest, and so there are two people or two groups of people who have a claim on those earnings. First in line are the preferred shareholders, and they get their dividends of $10,000. So of the $100,000, $10,000 goes to the preferred shareholders, which means there's $90,000 left. The non-controlling common shareholders are going to get 40% of that, or $36,000. So the total income to the non-controlling interest is $46,000. Again, $10,000 of preferred dividends plus $36,000 of income that's attributable to the common shareholders. So let's take a look at the bottom of the consolidated income statement. We'd have consolidated net income of $200,000. Again, that's the sum of Big and Little's revenues and expenses and so on. Less the income to the non-controlling interest of $46,000 equals the income to the controlling interest of $154,000. So the consolidated basic earnings per share is going to be the income to the controlling interest of $154,000, less Big's preferred dividends of $20,000, all that divided over 100,000 shares, or $1.34. Now we can view the income to the controlling interest in one of two ways. The best way to do it, the most accurate way to do it, the correct way to do it, is it should be the consolidated income less the income to the non-controlling interest. Now the textbook approaches this in a slightly different fashion when they go to deal with diluted earnings per share. They view it instead as being essentially the sum of the parent's individual income plus their share of the subsidiary's income. So the parent had individual income of $100,000, plus they had their share, $54,000, of Little's income. Now again, Little had basic earnings per share of 90 cents per share. Big owned 60,000 shares, so their share of the income was 60,000 times 0.9, or $54,000. So let's go ahead and move on to diluted earnings per share. And just as a reminder, the basic earnings per share was $1.34 per share. Now let's assume that Little has some convertible bonds outstanding. The per share effect for these bonds is $5,000 divided by 20,000 shares, or 25 cents per share. And again, this business of computing diluted earnings per share and the per share effects and all that, that's something you should be familiar with from your Intermediate 2 accounting class or equivalent. If you're rusty on that, that's something you're going to need to review at some point before you move on to your professional career. Little's diluted earnings per share, again, we take their basic earnings per share, which was 100,000 minus 10,000 over 100,000, and we add the numerator and the denominator of the per share effect to that fraction. So basically the numerator now is $95,000 divided by 120,000 shares, or 0.79166666 per share. Now because of the change in earnings per share, again, previously it was 90 cents, now it's down to just under 80 cents, and because of the change in the number of shares, Big's share of Little's income has changed. Whereas before Big's share was 60,000 shares times 90 cents, or 54,000, now their 60,000 shares only bring 0.791666 cents per share, for a total of 47,500. So the way the textbook is going to do the diluted earnings per share, they're going to start with the income to the controlling interest. And again, that $154,000, they view that as the parent's own income of $100,000 plus their $54,000 from the subsidiary. They subtract out the old portion of the subsidiary's income of $54,000 and replace it with the new revised figure of $47,500. All of that divided by the parent's 100,000 shares. So diluted earnings per share, $147,500 divided by 100,000 shares, or 1.475 per share.